Welcome back to U.S. Farm Report this weekend. Jared, we talked about the crop production, what your expectations are from USDA, but as we see WASDE this week, there are a lot of question marks when it comes to China. Buys have kind of been very quiet. USDA seems a little aggressive when it comes to their number for corn demand. Do you think that USDA starts to make some of those revisions soon?
Well, I don't think they can make any changes on the 2020-2021 balance sheet until September or most likely October at the earliest after the September stocks report. I do think you have a little bit of risk of seeing somewhere around 100 to 150 million bushel cut in old crop corn exports. That certainly could still be on the high side. But if that actually comes to fruition, it opens up the door to making any changes on the 2021-22 balance sheet. I wouldn't expect any changes from a demand side for that crop until probably January at the earliest. So you're kind of in a dead zone from a demand perspective, unless you see a new wave of Chinese buying, or for that matter, any other countries. I think that, the high prices to cure high prices has somewhat come to fruition in the last couple of months, as our export sales and chatter on that front has been relatively mundane. So you just got to see some new sales come onto the books here in the next couple of weeks, or a couple of months, I should say, to avoid any type of negative headwind going into the first quarter of 2022.
Well, China hasn't been immune to some of the weather issues when it comes to crop production, Mike. I know China is always a mystery when it comes to demand, but do you think there is an opportunity to see more demand come in from China?
There's a possibility. To your point, the Henan province has been flooding, and that province represents about 9% of Chinese corn production. There could be a little bit of a retraction in their numbers, but I'm always first to say that I never trust data that comes out of China. Watch what they do, don't listen to what they say. So as we observe their demand, it'll be more a matter of seeing how they come to the table. They were, pretty aggressive buyers when corn was at $5. Now that we're at $5.50, they've seemed to have, backed away a little bit. There was some sales that came through on Thursday with the export numbers showing a little bit of a perkier export than what was expected. But that could be attributed to the Argentinian trucker strike and the inability to load boats there. So as we talk about what's going on with China going forward, I think the other thing to keep in mind is African swine fever has become an issue again for them. We haven't seen the mass reduction in herd size like we saw in 2019, 2018, but at this stage in the game, it's a mystery at what they're going to need for feed and how much more they're going to need to offset maybe some of these crop losses they've had.
Yeah, Jared, as China remains a mystery, and you look at some of these 2022 pricing opportunities, what do producers need to be thinking about as they're heading even into the 2021 harvest right now?
A lot of the conversations we've had here recently is make sure they remember back to 2012, 2013 mistakes that happened on many farms, buying high-priced inputs, not selling to grain, putting themselves in a negative margin situation pretty quickly into 13 and 14. Some of these input prices right now, from a fertility standpoint, being up 75 to 90% higher year on year, going to create some tough decisions. A lot of my client base can actually make a decent return at $12.50 to $13 beans and $5 cash corn. But I would add that I think that all producers need to talk to their insurance agent about a particular program called margin protection to protect both price, yield, and input costs. And that's something that comes around here very quickly. You need to be signed up for that by actually October 1st, and the averaging period starts August 15th. It's a great tool to be looking at for 2022 if you have the fear of a cliff dive coming our way after buying all these elevated input prices.
Well, from grains to milk, you look at these COVID-19 cases, okay, and you see the headlines, and there's concerns about what, restrictions will we see put into place. New York now requiring vaccines to eat in restaurants. When you look at the dairy side, do you think that does create some downside risk for prices?
Yeah, ultimately, as we look at COVID, that's part of what's been stressing out even the soybean market. Our concerns about what's going to happen in Asia, and back to that Chinese story. That's why soybeans have been a little softer here earlier in the week. Bottom line is, as we talk about dairy, we share the same concerns. Dairy, is concerned about the movement of product in the country. Dairy is concerned about any shutdowns in restaurant eating, not just in the United States, but in other parts of the world, because a lot of that cream, that fat, all that stuff moves into those restaurants more quickly. The good news for dairy here domestically is that, as we saw in the COVID pandemic, there was a big heightened interest in retail demand for dairy, and fluid milk sales went up, and cheese demand was on the rise. And what's fun about this year is that we're seeing even more cheese demand than what we did last year, which was heightened from the previous year. So between frozen pizzas and stay-at-home dining, if you will, the added consumption of fluid milk, dairy performed pretty well, provided, of course, that the government demand was right alongside what the consumer was doing. So we have some concerns, and I think that's shared across the entire meat protein sector.
All right, Mike, Jared, thank you so much for joining us this weekend. Stay with us, because speaking of COVID-19, actually rural vaccination rates are on the rise. We'll tell you where next.